All right, we're on example 24-11. And so in this scenario, we have a company that can, we have Portland Lumber Company, and they manufacture rough cut lumber. And so the options that they have is like, do we just do the rough cut and sell it, or do we process it further and sell it for a higher price? And so, see, in this situation, we have Portland Lumber incurs cost of $452 per 100 board feet for rough cut. So let's just plug that in here. So we have 452 is our cost for rough cut, and they sell it for $611. So they make profit of $159. This is, or what they can do is they can process it further at a cost of $559 and sell it for $748. So in this scenario, it would actually be more beneficial then to continue the process, get it to that finished cut, and they'll make an extra $30 per 100 board feet. In example 24-14, and so in this scenario we have, do we accept a special price? So, is it worth it for us to actually sell a product at less than we normally would just to make more sales? And so there's two things to consider in this one besides just the numbers. The first is, do you have the capacity to do more? And so in this situation, they're operating at 80% of capacity. So yeah, so they could actually ramp up. There's 20% capacity that they're not selling. So as long as they have a positive contribution margin on that, it would be a good idea to do it. The other problem or thing to consider in this situation is, if you're selling a product to your customers, let's say it's at $20 per unit or whatever it is, and you have the option, and say your cost is 10, and you have the option to sell it at 15. It's like, okay, you're still making a profit, but you have to consider what effect that's going to have on your existing customers. If you have a situation where you have one customer buying it at 20 and another buying it at 15, that could possibly negatively affect your sales with your relationships with your existing customers. So that's something to consider. So in this scenario, it looks like, so they have plenty of capacity, and so that's not an issue. And this looks like a special contract with a government entity. So chances are, hey, if you give a government entity, whether it's a school or whatever it is, a special deal, that's probably not going to create issues with your existing customers. So if we take a look at this one, so we have total cost of production of $375,000, and if we back out our fixed cost of $112,000, we have total variable cost of $263,000. And so this is based off 25,000 units. So our variable cost per unit is $10.52. And so this question is asking us, hey, what price would it be worthwhile to do this? And so if our variable cost per unit is $10.52, that means anything above that would actually create more profit for us. So even if we sold it at $10.53, it's actually probably a good decision for us to do. So the answer to this one is anything above our variable cost, which is $10.52. All right, in example 24-19, we have target costing. And so in the idea behind this one is pretty simple. It's usually most of the time, if we're selling a product, there's going to be a market price. We just can't charge whatever we want to charge. So, sometimes, a lot of the time, the market is going to dictate the max that we can charge. So in this situation, we have Toyota, and the market price for this car is $27,000. So we really can't change that. But Toyota, for order it to be worth their while, they say they need to make 20% profit margin. So that's usually called a hurdle rate, when a company says, hey, we have to make so much, or otherwise we're just not going to do it. Because they probably have other options that they can make, that they can make that money. So since the selling price is kind of set, and we know that we need to make at least 20%, that means we have to get our cost down to a certain target. So in this situation, what's the selling price going to be? Well, the market is going to dictate that. The selling price is going to be $27,000. So in order for us to hit our hurdle rate of 20%, we need to figure out what our costs need to be, which means we have to be, whether that's finding new vendors, being more efficient, or whatever it is. So we have our target cost. And so if we need to make 20%, so 27,000 times 20%, and subtract that from our selling price, that means we can't have costs that exceed $21,600 in order to achieve that 20%. And so right now it's telling us that our costs are estimated to be $22,500. So in order to meet our 20% profit margin, we need to figure out some way to cut our cost. All right, last problem is 24-1A. And so this is opportunity cost. And so we have two decisions to make money. We can either rent some retail space and equipment and sell goods in a retail store, or we can just take that money and invest it. In this case, it's treasury bonds. So we need to figure out what is the best option here. So if we want to look at operating our retail store, let's first do the easy one. Let's just do the investment in the bonds. So if we invest in the bonds, we are going to have, the investment would be $180,000 at 6%, and it's going to be over 16 years. So we'd make interest of $172,800. So no cost involved with that. So we have an income of $172,800. Now let's look at the retail store. So the potential revenue for this retail store, it tells us that our expected profit during the first 8 years, so we got our first 8 years, is going to be $85,000 per year. And then the remaining 8 years, they're projecting profit of $73,000 per year. So over the 16-year period, we're expecting $1.264 million profit. And so the cost to operate the store, it tells us that excluding depreciation is $58,000. So that's important. If it said it included depreciation is non-cash, and that's going to be irrelevant in this scenario, so we'd want to back that out. But this excludes depreciation. So $58,000 times 16. So cost to operate the store is $928,000. And then cost to buy equipment less residual value, so less whatever we're going to sell it for at the end. So it looks like it would be $180,000 minus $15,000 of residual value is $165,000 net equipment cost. So the income would be $171,000. So we can take the risk of opening a store, buying equipment, making sales for $171,000, or we can invest in pretty much risk-free treasury bonds at $172,000. And so in this situation, it's probably the better deal is to invest in the treasury bonds. So do we want to lease the retail store? Probably not. You know, in this situation, you also kind of have to consider, the risk of doing this. So, operating a retail store over a 16-year period, that's a pretty high risk proposition. So, even in a scenario where, you're making $180,000, maybe even $200,000 operating the retail store, it still might be a better deal to do the treasury bonds. So I think, to compensate for that risk, you'd probably need a much higher return on the retail store to make it worthwhile.